being here with us today, Scott. I will kick it over to you now. Thank you.
All right. Thank you for that kind introduction. Good afternoon, everyone, and thanks for inviting me back to chat a little bit about the economy today. Yeah, wow. There's certainly a huge amount of ground to cover, and I think Jamie said I only have 2 hours, right? Well, with luck, we'll try and power our way through the entire deck. I'm kidding. It's only one. If not, you have the PDF handout that is free for you to keep as a souvenir. So, okay, let's jump right in because I know you're all excited. First, a couple of housekeeping comments. The usual disclaimer whenever I present: the views and opinions expressed are those of the presenter, not necessarily those of the Federal Reserve Bank of Atlanta or the Board of Governors of the Federal Reserve System. Subsequently, maybe this should be considered for entertainment purposes only. Here's the agenda today for a romp through the economy. We'll talk a while about the macroeconomy, the Florida economy. If there's time, the residential and commercial real estate markets in Florida, and well, we'll close it out with a statement from the FOMC. Okay, so here we go. The macroeconomy. The first stop on our whirlwind tour is spending a few minutes on the macroeconomy. Of course, let's start off with a bang. This is our standard GDP growth chart that we use. It looks a little bit different than I've shown in the past, but still contributions to real GDP, which means those are the columns. If you sum those up, you're going to get the total, which is the black line, which shows real GDP growth. You know, honestly, I never thought I would be seeing a chart like this. The 2020 quarter two data sort of, yeah, it blows out the scale on the chart, doesn't it? If you notice, if you have the PDF handout already, you'll notice some differences in the charts we look at today. This is due to some revisions and new data releases. Talking about the economy is sort of like hitting a moving target nowadays. And you know, this chart is no exception. Last Thursday, we got the revised numbers. Not much of a revision. The seasonally annual adjusted rate of decline in the GDP was nearly, oh, I almost shudder to say this, 32% in the second quarter. If there's any consolation, it is a 1.2 percentage point above what the advance estimate was a couple of weeks ago. In any event, you know, we should take a little bit of a historical perspective. If you recall, during the last Great Recession in 2008 to 2009, I wonder what we're going to call this one. The steepest quarterly drop was minus 8.4%. That was at the end of 2008. If we go, and we thought that was horrific at the time. If you go back to the beginning of 1980, there was a recession then. One quarter was a minus 8%. If you go back to the beginning of 1958, there was a quarter in a recession where it was down by 10%. If we go even further back, pre-1950, all the data was annual, so we can't talk about quarterly. But after the close of the Second World War in 1946, we saw GDP slump by 11.6%. And then if we go back even a little bit further and take a look at the Great Depression, 1932, for the year it fell by 12.9%. So just a little bit of context, but when we look at this quarter going forward, oh my, this is definitely one for the history books. And like I said, I wonder what we're actually going to end up calling this downturn as we go forward. But still, I mean, that was the second quarter. If you go back one quarter, the first quarter of 2020, you can already see the effects of COVID and the beginnings of the lockdown starting to affect GDP. I mean, we did decline a little bit in the first quarter. And in fact, the National Bureau of Economic Research, which I guess they're the supreme arbiter of whether or not we're in a recession or expansion, they recently stated that the economy actually peaked in February and subsequently went into a recession. And just looking at the columns there, I mean, you have to squint to see some of the different columns, but you can see that above that 0% access, only government, and that's really federal spending and trade. Those are the only two components of the economy that even mildly ameliorated the depth of Q2 numbers. Of course, the green portion of the column, the big one, that's consumer spending. But consumer spending is made up of a lot of different things, and let's take a little bit of a closer look. And we can do this by drilling into the data. And really, this is a question for the quiz at the end. Why is consumer spending so important? Okay, note down your answer because I'm going to ask it at the end. It accounts for about 2/3 of GDP. So what happens with the consumer typically happens with the economy. And this is a great table. We could tease out so many different stories from it. We could spend easily another 30 minutes on this. I don't think you want to do it, but maybe you do. It's fun. But even though we don't have long enough to really delve into all the details here, I will tell you that this table comes directly from the Bureau of Economic Analysis. I just took it. And the only thing I did is I color coded it. So you can see here in the table, if it's a positive contribution to GDP growth, it's shaded green. And if it's red, it's negative. And then you have all the shades in between. Once again, we got revised numbers last Thursday. So in the PDF handout, this may be a little bit different. Now, just bear in mind, okay, so here we have contributions in 2017, 18, 19, and then, yes. I just realized this morning there's a laser pointer associated with this, so I'm quite impressed. And then here we see the first quarter, we see that GDP overall was down 5%. And then, as I said, about 32% here. So what was the largest contributing subsector to consumer expenditures in the second quarter? Well, look, I mean, here they all are under quarter two. Well, the biggest one that's green is 0.76 percentage point, and that's for recreational goods and vehicles. Okay, what does that mean? What falls into that bucket? A lot of things. I mean, you have bicycles, you have RVs, motorcycles, sports equipment, boats, ATVs. You also have computers and tablets. You also have ammunition and weapons. All these things contributed almost 3/4 of a percentage point to consumption expenditures. Down here, we also have 0.58, that's housing and utilities. Everywhere else, particularly on the services side, it was detractors. The biggest one, healthcare. That took off nearly 8 percentage points from our GDP growth. Wait a minute, we're in the middle of a pandemic. Exactly how would that work? Well, you have to understand that a lot of elective medical procedures and medical treatment had to be deferred. And so that accounted for the pullback in spending on healthcare services. We also see some pullback in transportation services, recreation services, and of course, food services and accommodation. So here, you see that on the right? That's a picture of my iPhone. And you can see that back on August 7th, if you squint really well, it said that in the third quarter, GDP now, which is a product of the Atlanta Fed, they were projecting 25.6% GDP growth Q3. Hey, that's great. Now, it's not a forecast, it's really a tracking estimate. As more data comes in about the economy as we go through the third quarter, they update this tracking estimate. So, as of August 7th, it was running at 25.6% for the third quarter. Now, you too can have access to this wonderful data. In fact, that's part of your homework assignment. You can go out and download the app from Google Play or the App Store. It's called Economy Now. Once again, that's your homework. Now, this number was updated on the 27th of August. So it was the same, and I was too lazy to take a picture of my iPhone again. But I'm glad I didn't, because if we go forward to today, this morning, oh, it's been updated yet again. They're projecting in the third quarter, well, not projecting, the economy is tracking at 28.5% GDP growth. Wow, that's great. But that's not going to get us back to a full recovery. That's going to take a little bit longer to get there. It may be quite a ride. Oh, and about the app, it's free. We aren't going to charge you. So, yeah, by all means, go download it. So we're going to see as time goes on, as we go through the presentation, there's a long path to recovery. Okay, now the GDP data that I just showed you, that's great, really detailed. As I said on that table from the BEA, we could spend more than an hour, we could spend a whole afternoon on that. But what's the end date of that? Well, it's June 30th. Wait a minute. Today is September 1st. I mean, it's 2 months later. To try and get our arms around more real-time condition, my team at the Fed has been adopting an array of more high-frequency data. One series that has been used to give a more up-to-date assessment is the unemployment insurance claims data. It's frequently cited in the media nowadays. And on the left axis, we have initial claims. And then on the right axis, we're measuring continuing claims. Now, they both add something different to our analysis of the economy. Initial claims is really useful at showing the level of severity as we first enter a downturn. I mean, it gives us some indication of how fast firms are laying off employees. Now, at the beginning of March, before things really blew up, initial claims are running around 20,000 a week. As the lockdowns shut down broad parts of the economy, within 4 weeks, you saw initial claims skyrocket to around 7 million. And you can see that right here. Once again, the orange solid line is for continuing claims. Now that tells us something a little bit different about the economy. It can give us insight, well, how fast are employees being pulled back to work? And as we can see here, we peaked out at around 25 million, and we're now down at 15 million. So yeah, and this is weekly data, so continuing claims lag by a week. But initial claims through the third week of August, I mean, wow, it's dramatic improvement, right? Well, as we like to say, everything is relative. So what this chart here does, it compares peaks and claims. The center cluster is for the first half of 2020. Once again, excuse me, initial claims topped out at close to 7 million, and continuing claims topped out at around 25 million. And here we are now, as of the third week of August. We see initial claims down around 1 million, and continuing claims down around 15 million. That's a great improvement. Well, kind of, sort of. If we go back over here to this first cluster, this was the worst depths of the 2008-2009 recession. We saw initial claims peak out about 670,000. Continuing claims reached their peak at 6.6 million. Well, we have improved dramatically, but where we are right now is even worse than the worst depths of the last recession. So trust me to find a dark lining to every single cloud. While the economy has made progress, full recovery, like I said before, is a distant process. And we can see this here with our chart on the unemployment rate and labor force participation. Now, this blue line is what we call U6. It's the broad measure of unemployment. And that includes folks who are considered marginally attached to the labor force, or people who are working part-time due to economic reasons. As you can see, it peaked out here at around 18% in June, and it has improved. It's gone down to about 16.5%. The regular unemployment rate, the one that they tell you about in the media, is called U3. And you can see that that peaked out here and has fallen. Hey, we're still in the double digits, but just barely. So there is some improvement. Now, once again, I'm going to have some rain on the sunshine. This orange line here shows labor force participation. Well, what happened to labor force participation as we went into the current downturn? It dropped. It means that it's going to bias our unemployment rate because remember, the unemployment rate is a ratio, unemployed to working. So it makes it hard to measure exactly what's going on when you have changes in both the numerator and the denominator. So we always have to pay attention to that. And we're going to talk a little bit more about that in a little bit. All right, this chart shows us job gains, and this is nationally. We talk about unemployment rates. We also talk about job growth. Employers last month, they added 1.8 million jobs, net new jobs. Wow. Any other day, oh, wow, that's great. Well, if we look here, that increase came from here to here. But look where we were before. We dropped from over 150 million jobs down to about 130. You have to look at this in context. Back over here, this shows us the year-over-year percent change, these columns. Here is the Great Recession. And as we can see, at one point, we were down about 5%. And that was a slow decline from the beginning of 2008 until about 2010. And then we started adding jobs. So that entire time, our growth rate never really went below 5% in terms of job growth. Here, wow, we just collapsed down almost 13%. And we've had, coming back, but year over year, we have a long way to go. This was a slower decline. This was like falling off a cliff. So here's where we are now. I mean, we're back to where we were in 2015. So context is important. Now, before we were talking about unemployment rates, and we talked about the ratios a little bit, and it makes it kind of murky. Now, my friends in research up on the, well, we're all working remotely, so I can't say ninth floor. My friends in research put together a great spider chart talking about different aspects of the labor market. And they divide the labor market into 5 sectors. One measures employer behavior. We also have confidence and perceptions. We have utilization of labor, wages. And then we have flows in the labor market. So this is a more nuanced way to look at labor market conditions rather than just saying, oh, the ratio of unemployed to the size of the labor force, which is both are always moving. So this gives us a better view. Now we put those 5 areas and we break it down even further, and we're creating a web here, a spider chart, and they're all classed. Like here under employer behavior, we have changes in payroll employment, private job openings, private hire rates. That's all employer behavior. Over here, we have wages, things like average hourly earnings growth, employment cost index growth, and working part-time for economic reasons. One takeaway from this is to be closer to the center of the web is bad. And the further you move away, that's good when we're talking about comparisons of different parts of the labor market. So I'm going to add up a few lines here, put it all together. Now, just to confuse you, I changed dates on the chart, since I thought it was important to talk about where we were from the peak in February to now. And because there's been a lot of, I hope my computer is telling me it's downloading software. Better not reboot. Since February 2020, you've seen a significant degradation. So for comparison, the dark blue line here refers to the depths of the Great Recession. Maybe we should call it the Great Financial Crisis now and call this one the Great Recession. But anyway, in December 2009, labor market conditions were at its worst. And we can see that here. That's that blue line, very close to the center of the web. We still had some earnings growth, but these are the worst measures since 2000. That's how far the data goes back. Now, if we take a look at the green line, that's February 2020. That's right before we went into a recession. And remember, I said the initial claims were running about 20,000 a week. Wow, that's the best in decades. So that's further out on the web. We were still lacking here with some work for part-time reasons. The unemployment rate was really low, historic lows. Some firms were having trouble filling jobs. A lot of firms were planning on hiring. So that's the green line here. Most of the metrics were very close to the outside of the web. Now here we are in July 2020. What a difference 6 months made. So one thing that's a little bit curious, payroll employment. Wait a minute. We're in the midst of a really sharp recession, a recession, as well as we've lost jobs. But here you're saying payroll employment, that's the best it's been. Well, remember, it's from the past month. How many jobs have we added? 1.8 million. Yeah, I mean, usually that doesn't happen. So that's why actually this is the best it's ever been. But it's more nuanced than that. We can see that working for part-time for economic reasons, boom, collapsed in. Remember, the closer you go to the center, the worse the labor market component is. We still have average hourly earnings growth. In fact, it's improved. Well, think about it. A lot of folks who have to actually go into the office or the place of work, they're getting premium pay now to come in. So hence we're out here. But other factors, we've collapsed in. So we're going to have to see how this evolves going forward. All right, now let's begin our journey into a more regional level of discussion. So what this tells us here, these are county unemployment rates, and we've seasonally adjusted them. And this is January 2020, at the outset of the year. So if your unemployment rate was below 4%, you're shaded dark green. And we can see much of Florida, dark green, yes. Low unemployment rates, same with Atlanta, same with Alabama, broad portions of the economy. And much of it is also 4 to 8 percentage points unemployment. You'd have to look really hard to find areas of high unemployment. Places like parts of Alaska, here along the Mexican-American border, up here in Appalachia, maybe along the Mississippi. Okay, well, let's jump forward just 6 months. How does this change? Ugh, that's kind of frightening. Suddenly, it's a different world. This is June, it's not even July data. Now we can see broad swaths of the country are orange or red, and red is above 12%. So here we see New York City, lots of Michigan, here on the West Coast. And yeah, here in central and southern Florida, Panhandle's holding up. Still, there's a lot of weakness out there in just 6 months. And remember when I said when we were looking at employment levels, unlike the 2008-2009 recession, this was more like falling off a cliff. It was because of the speed that the virus spread and also the lockdowns, which shut down employment. It just happened. Okay, one more macro chart, and then we're going to drill into the state of Florida. So here, this just shows us income. Now remember, you have personal income, but that can be helped by transfer payments, or in this case, unemployment insurance. Now we can see when the economy was expanding, the orange and blue line were nearly right on top of each other. But then as we went into lockdown and the pandemic, we began to see problems in the economy. And that's when we got additional assistance from the federal government, unemployment rate, unemployment insurance benefits. And this shaded area here is the gap between personal income and subtracting or less unemployment insurance payments. So you can see how wide this gap here is. So without these payments, here was our peak before, here's where our income would be now. Now up here, it did peak, but it's come down since. Some of the emergency payments have stopped. So it is headed down, but where would we be without unemployment insurance or transfer payments? This is where we'd be. So it's not just jobs, it's also income. Okay, so let's move forward. Okay, enough of the macroeconomy already. You're probably depressed by my discussion, but this is Florida. How has Florida fared in all this? Now, this is a fun chart, but we have to sort of track 3 different employment concepts to fully appreciate how much fun it is. Now, this data comes from the Bureau of Labor Statistics, their CES, or Current Employment Statistics Program. So the first component, it's the size of the bubbles. The bigger the bubble, the more employment a state has. So it's all proportional. So number 1, California here. As of July, they had 15.8 million people working. Number 2, over here at Texas, 12.1 million. Who's number 3? It's always a toss-up here. But no, it's Florida. 8.5 million people working in July. Florida is number 3 in terms of total employment. Well, New York's only about 15,000 employees behind, so it's almost the same. Now, the horizontal, so that's the first component of the chart that we have to understand, is just the proportional size of the bubbles. Now, here along the horizontal axis, that gives us trend growth over the past year. Notice it goes from 0% to minus 20%. Okay, so over the past year, no state is above where they were 12 months ago. All states have lost jobs. Now, the best performing states from this point of view, best is in quotes, because all states lost employment, are these three dots here. And those are Arizona, Utah, and New Mexico. But still, they're still declining. So best in quotes. Now, what about this over here? It's a very small bubble. I'm not even sure you can see it. That's Hawaii. Hawaii is it's very dependent on international and domestic tourism. And that got shut off almost entirely. Now, Florida that's an important industry for Florida as well, but the Florida economy is much more diversified than Hawaii. So, but that was the poorest performing economy on a year-over-year basis. That's around 17%. Imagine in 1 year, you've lost 17% of the number of people working. It's huge. Now, this vertical axis over here, we call that momentum. So that's where were we versus a few months ago. Now, we saw that the whole country added 1.8 million jobs. Well, the good news is all states saw growth over the past 3 months. So the momentum is positive. The trend is negative, the longer term trend. And so how fast you move on this momentum part of the axis, and that's a measure of how quickly you're bouncing back. And that's reliant on such things as the strictness of the shutdowns, when the COVID infections peaked or maybe resurged, and how quickly states reopen, as well as a state's economic diversity. So let's isolate Florida's experience a little. This is just like the US chart I showed a few slides back, but it's for Florida. So it shows employment for the state. On the left axis, that measures year-over-year change, these green columns. In late 2007, we see growth, began to evaporate back here as we went into the Great Recession. And we see, corresponding decline. The red line is level of employment measured over here. And thereafter, we grew. This contrasts with what happened with this most recent downturn. It's like falling off a cliff, just like the US. In fact, back in, I think that's March, if you squint really hard, that's, only 0.8% of job growth in March, year over year. And then by April, you're down, I think, about 12% year over year. Growth has been coming back on a monthly basis. We can see that going from here to here. But even then, where have we recovered to? We're back where we were in 2016. So, and even when we look at this line here, the year-over-year growth, growth rates actually peaked in Florida back in late 2015. And they've been sort of moderating ever since. Now, this point here and this point here, that's because of our hurricane impact. So, but still, our peak growth came in late 2015. So, and right now, even though we've had a few months of great growth, we're still 6.7% below our peak. So it's going to take some time. But of course, this is just for total employment. Now this is even more fun. We could spend a lot more time on this and even the GDP contributions table. And this is fun. So let's begin to break down Florida's total employment by sector. I love this graphic, and I'm sure you will too. It's great because you can tease so many stories out of a single graphic. We could spend the next hour or two on this one as well. See, on the left, we have total up here, of course, and then we have the major sectors of the economy. So the main part of this chart or table here shows us the annual change in employment. And each cell is color coded like the GDP one. So the deeper the shade of red, the starker the data, the employment losses. The brighter the green, the more employment gains you have. And just for reference, here's 2001, we had a recession. And here's the 2008 and 2009 recession. I put those in blue boxes just for some fun. And then, since annual data ended in 2019, I went ahead and I put in July year over year. And then over here, not all jobs are created equal. So I put in the average annual wage in 2019. And the brighter the green, the higher the wage. So you can see here, information sector, average wage is $86,000 a year. If you go down here to leisure and hospitality, it's only $26,000 or so a year. So it's important that we see where jobs are being lost or gained. Now, I don't think you want to spend an hour on this one. I'm only going to point out a few highlights, and the rest of the analysis can be. So immediately, what jumps out at you? Oh yeah, oh my goodness, look at that. Over the past 12 months ending July, Florida's lost 500,000 jobs, 500,000 jobs. If we sum together, that's worse than the depths of 2009 by about 15,000. That's wow. And this just happened since the start of the year. So what else? In the last recession, and we really do have to come up with a better name for that, you'll notice here down, education and health. Yeah, well, it slowed a little bit, but it stayed green. The last recession didn't stop education and healthcare from continuing to expand employment. Yeah, but then we get over here, and you remember the discussion we just had about healthcare when we were looking back. If you recall the contributions to GDP, healthcare was the biggest drag on the economy in the second quarter for consumer expenditures. So yeah, that lost too. Now, of course, which sector lost the most over the past year? And there it is. Leisure and hospitality, down 240,000. Now, if we go over here and we look at the average annual wage in that sector, that's probably going to tell you that this downturn thus far has had an outside impact on poor members of society, and often folks at this level, they have no extra currency or income to save for an emergency cushion on which they can fall back on. So they're at risk, but this is where the job losses have occurred. So if we go back here, which sector was the most impacted? Well, that's easy. We all remember the housing bust. There's construction. 100,000 one year, 120,000 the next year. And look, the average wage back then, or the average wage right now, is 52,900. Wow, that's almost twice what we have here in leisure and hospitality. So the total income effect on the state was likely greater here, even though the total number was here, just by virtue of the higher wage. So now, wait a minute, I can see you saying this. Didn't I say we had to look at more high frequency data to examine the economy, more real time? We're 3 slides into the discussion of Florida, and the data only goes through July. Today is the first day of September. Already we're looking forward, hopefully everybody's looking forward to a nice holiday weekend to sort of begin to wind down summer. But July, that's so peak summertime. It almost seems like ancient history. Plus, when we look at the survey, remember I said the CES survey from the BLS, that's usually done on the week of the month where March 12th falls. So it might be as of the second or third week of July that this survey was actually conducted. That's even further back. So, and I can hear you all saying, because everybody's microphone is unmuted now, I'm just kidding, it's muted. But you're saying, come on, Scott, you promised us high frequency data. Okay, fine. Here, it's September 1st. Where are we now? Here's some employment data for small businesses in Florida. And it's just 1 week old. That is as of August 23rd. We get this from Homebase. You may have seen it referenced in the media. So it bests the establishment survey or the CES program by over 1 month. We're getting pretty close to real time here. The data are by major sector, and we can measure the percent change since the week of March 8th. So that's our baseline. Now, this is a little bit different than the PDF I sent because it's high frequency data. The data now goes through August 23rd. I think in the PDF I sent before, it only goes through the 16th. So another week of data. If we were to look at the entire state, we can see, I mean, not by sector, but if we looked at total employment at small business, in the state, we can see like maybe around middle of April, the state, bottomed out and employment began to claw its way back at small employers. But what we'd find as we move through, now remember the July data, things have increased. We go back to that line chart. So employment is increasing. Sorry, I just got a message, slow data. So the rate of growth for total employees began to taper off in late June and actually declined slightly through mid-July. It peaked. Oh, sorry, Jamie. My mic is getting caught on my shirt. Oh, sorry. So it peaked around about 78% of March 8th levels. Overall growth has continued, but only modestly. In mid-August, total employment was just increasing slowly. But as you can see, employment increased widely, depending on the sector you look at. For one, look at home and repair. Wow, we're 14% above where we were in the beginning of March. Yeah, just as a side note, my honeydew list has probably spiraled this year, so this may be entirely due to me shopping at Lowe's and Home Depot. But maybe not, maybe everybody else is working on their house. And we also see transportation is up about 16%. Well, guess what? We're all shopping at Amazon or Walmart or other online ways of getting food and supplies. So yeah, we've seen growth in e-commerce, so you would expect transportation to increase. So, but you see these other ones, retail, growth is flattened. Here, leisure and entertainment, it's actually trailed off. Food and drink, and that's outside that you take, not at your house, that you take out, it's flat. So here's professional services. So some parts of the economy, and we see this nationwide as well, it's beginning to taper off. But that's why we have to look at high frequency data. Now, of course, we can drill into the data by individual market. So these are by metropolitan area. It's the same as before, compared to March 8th. So what we see is only Gainesville and Panama City have gone beyond March 8th levels of employment. Other states, other markets, it's actually, they had that rebound starting in mid-April, but it's begun to taper off, or it's begun to flatten out. So it depends on which market you're in, where you're going to see growth. Right now, we've only seen, as I said, Panama City and Gainesville. We can also look at other data, and we can also look at weakness by industry when we look at the percent of small businesses open. This chart has data from Economic Tracker. It's not quite as current. It only goes through August 9th. So, but it tells a similar story. As we saw back here in April, that was the trough. Then we saw as lockdowns lifted, businesses began to open up, and we see that. But right here, once we get to the end of June, it peaked, particularly for leisure and hospitality, and it's been trending downward. Now, the increase probably is associated with lockdowns and perhaps, supported by Paycheck Protection Program. Starting in July, however, things have changed. So this goes along with our other high frequency data. We can also see some of this through credit card and debit card spending in the state. It's been showing moderating levels of growth across sectors. And this data goes through August 16th. I think I updated that. But what's really curious is this green line here. That shows us grocery and food stores. Wow, look at that peak in spending. All right, now everybody fess up. Who went to the store and stockpiled food or other products? It shows it right here. And then it went off. While everything else went down, everybody else was rushing to Publix. So that happened as Florida went into lockdown. You had that spike, and then there's been slow improvement, but that improvement has tapered off. Further evidence of stress in small businesses can be seen by rapid increases in small business default rates. We get this data from payment. It's monthly. Yeah, I know it's only through June, but you can still see some initial trends in financial stress and among small businesses. Since January, overall default rates, they've risen by about 100 basis points. So here to 4.29%. And I rank these highest to lowest. Now you'll notice the highest one is transportation and warehouse. Hey, but Scott, you tell me we were just there, and you said that that's where we're seeing growth. Well, if you take a look at their default rates here, 9%, 9%, 9%, 9%, 9%, it's always just under 10%, but it's actually come down in the past few months. So that may be normal for that sector. But when you take a look at these other sectors, you're seeing sharp increases, notably educational services, fire and insurance, finance and insurance, and of course, accommodation and food services. Now, we've also seen a reflection of this with increases in personal and business bankruptcy filings. I don't think this is in your handout, but another indicator of stress caused by COVID-19 and lockdowns can be seen with the paycheck protection loans that were made in Florida in Q2. Now, these are the sum of individual loans that were originated for less than 150,000. So we can see here, yes, full service restaurants took 7.3% of the total. Then we have, once again, healthcare. We talked about that decline in GDP. Well, we can see evidence of that here, and dentists. I think I'm getting a question, two questions. First, on construction employment, positive in 2020. Are we worried about a housing bubble? And then second, ask his thoughts, I guess you mean me, on the polling question reserve levels. Well, I'm not sure we're going to get time. I'll get to at least the first part of the question in a minute. So let's move on so we can get on to a couple of comments about housing to address at least that first part there. I know you're all saying, so gloomy. No wonder economics is called the dismal science. Just to add perspective, I am the director of the risk analysis unit. My job is to look, at developments that may pose a risk to the banks we supervise. So in a sense, being gloomy is part of my job description. But okay, so here is one ray of sunshine. The data on this chart is from the US Census Bureau, and it shows high propensity business applications. So wait, well, what's high propensity? Well, the census defines that as those businesses likely to succeed and grow. How that's measured, that's a little bit unsure from the census. So anyway, we can see that this red line is 2020, and then I put on here on this gray line 2019. We started out the year on an optimistic note. High propensity business applications in Florida were running above last year. And then here we see the descent into the lockdowns. Well, what happened once again in April, we saw a pickup in business applications. And by the time we get here to the end of June, well, we're well above where we are last year. Now, some of this may have been making up for deferred applications back during this time period. But the fact that there's some optimism at this point is hopeful. I mean, people are interested in starting a business. Now, that's something we're going to have to watch going forward. But this leads to a bit of an anomaly. When we look at the Senior Loan Officer Opinion Survey for July, we see underwriting for C&I loans, commercial and industrial loans, tightening the levels that we haven't seen since the last recession. As well, demand for commercial and industrial loans has fallen off sharply according to the survey. So if we're seeing this increase in business applications, where are they getting their funding from? Is it from fintechs, maxing out their personal credit cards, savings? It's just something to consider if this trend persists. How are these businesses, these new businesses, getting funding? Okay, so I have about 5 minutes. Okay, so I'm going to leave the real estate slides because I don't think we have enough time unless you give me another hour. I'm going to go ahead and talk a little bit about the FOMC statement. Come on. Sorry, my computer is freezing for some reason. But one thing I did want to point out is this. I talked about tightening underwriting for C&I lending. We also have that here for mortgages. Now, what we've seen so far is that home sales were impacted in Florida by the lockdown, but they have since recovered just about to where they would be in this seasonal part of the year. But how is that the case? We see that home prices have continued to rise in most markets in Florida. A lot of that, not only has it been to a recovery in sales, but rapid declines in inventory. So you're shrinking supply, you have this demand out there, so prices are going to go up. How this is going to fare going forward with tightened underwriting, we'll see. Plus, here are first lien mortgage delinquencies by zip code. This first map is delinquencies by zip code. Yes. Here's June 2020 versus 2019. What we can see in this last map here are increases, areas, pockets where we've seen strong increases in past dues. And we can see that Miami and Orlando are two of the biggest markets. And I have 3 minutes, and I've been reminded that what you may be most interested in at this point where did it go? Yeah, I can show it. Just run through the July 2020 FOMC statement. You know, it's just summarizing what the FOMC said late last, almost a month ago. Just that the pandemic continues to cause problems here and overseas, and the course of the economy going forward. It's really going to depend on what happens with the virus. There's a lot of uncertainty. So I've used up all my time. One thing we didn't get to the real estate. If you have any questions, they can. I think they'll supply you with my email address. You can send me as many questions as you want, and I'll reply to them. So with that,
Thank you,
Paul.
Thank you very much. I wanted to ask you one question before we let you go. And we asked a polling question about where folks thought their reserves would be at the end of June. So that's 2021.
So what were the results?
So the results were that 59% of the respondents thought it would be a 101.5, 150 basis points or less. Only 10% of the respondents thought it would be over 2%. Now, you just showed us the delinquency going up in residential, and I know your official regulatory response is you'd want more, right? I'm teasing with you, but you know, how does the Fed view the credit cycle? I remember in February 2019, you asked that question and everybody thought the credit cycle turned. Nobody knew about COVID.
Yep.
What are you expecting reserve levels to look like, going forward, do you think?
Well, I'll answer a different question. As a regulator, since mortgage delinquencies are going to continue to rise, there's going to be a lot more stress on consumers, and that's going to affect asset quality. So, one, we've had the emergency unemployment benefits stop being paid. And if you take a look at that $600 a week, what is that in annual terms? If somebody is making $600 a week, that's $32,000 a year annualized. So suddenly that stopped at the beginning of August. Lots of people were relying on that. In the housing markets, you know, my son is looking to buy a house up here in Atlanta, buy his first house. And it's really emerging as a bifurcated market. You have almost a land rush at price points above 300,000. So a house will come on the market one day in a desirable neighborhood. It's gone by the end of the day. They're even bidding for it. Yep. But how does that square with the rise in delinquency rates? Well, remember, who's being affected thus far by the downturn the most? We saw that back at leisure and hospitality. We can tell those are low-income jobs because we see those average annual wages. So at those lower price points, that's probably where we're beginning to see some degradation in asset quality. And going forward, particularly what's going to happen now that banks are tightening up their underwriting, we'll see what happens. So the stress isn't over for the consumer or for businesses. I mean, you saw the default rates and you've seen the rise in business bankruptcy files. Stress is out there, and just like the economy hasn't recovered, it went down sharply. It's going to take time for that financial stress to work its way through the system. So I sort of answered your question.
No, you gave us, that was good, Scott. And Scott, I just wanted to take a minute and say thank you for joining us. I know every year folks are just so appreciative of your time. You have a great slide deck, and Jamie, that slide deck is available to our attendees, so you can spend more time in there. But I just wanted to say thank you very much. And I have already downloaded the Economy Now app so I can impress my grandchildren.
That was homework.
Yeah,
So
Papa's
you
got
did
this
that
right
in the
on
middle
the
of
phone.
class?
Absolutely. Absolutely. But I just wanted to say thank
Yeah,
you.
there's a lot of other great data in there. Yeah, it's my pleasure. I mean, I always enjoy coming down and chatting with y'all in person. I wish we could have done that this year. I always have a great time with y'all.
Well, hopefully
Thank you
next year
so much.
we'll be in person. Jamie, what do we need to do to wrap up here?
Yes, of course. Thanks again, Paul and Scott. We really appreciate you being with us again today. Thank you.